Okay, welcome everybody. I see we're starting to fill up the room. That's wonderful. If you can hear our voices, somebody raise their hand. If you can hear our voices.
Hello.
Anybody hear any voices? There we go. I see a hand up. So one person, at least now there's more. So more people can hear. Okay. And I'm going to put down people's hands. All right, welcome everybody to another fun session. Today we're talking about lending changes that you need to know in 2022. And my go-to loan agent, Jody Hatano, has agreed to discuss what you need to know in order to help your clients get the loan they need so you can get the transaction you want and all of us can be paid, right? Isn't that it? So why don't you go ahead and take it away, Jody?
Okay. Thank you everybody for attending the call. What that does, I think, to me and Mike, is show that your dedication to your career, especially starting out 2022. Clean slate. 2021 and previous already happened. It's in the past. Now we're moving forward, right? 2022, I think, is going to be an amazing year for us in real estate. There are lots of changes that have happened. Interest rates are on the rise. Everybody's heard that. I'm going to talk about a little bit about why. I'm going to talk about lending changes, and they're all positive, so that's a good thing. I'm going to talk about that, and I'm going to talk about some things at Golden One that we offer that sets us apart from other lenders. And we'll talk about a few little guideline changes and things like that. So if you don't yet have the presentation, I believe Mike or Ra will probably send that out at some point. Forgive me, it says October 7th. Obviously, it's not October 7th, but I can't go back and change it. So I trust you to remember that it's January this year. Okay, so
Yeah, that should be in the chat. Just sorry to interrupt you. So everybody should be able to get a copy of it in the chat. Click on it, and you should be good to go. All right.
Awesome. Okay, so here we go. All right, market update. The Mortgage Banker Association reported last week that purchase applications were up about 2%, but still down about 17% year over year. We kind of anticipated that because of the lack of inventory, right? It's all across the country. Rents rose about 0.5% in December and have increased about from 3 to about 3.3% year over year. I want you to keep that little tidbit in the back of your mind, because when you're talking with your potential buyers, and maybe even sellers that want to buy up and list, right? We need them to list. When you're talking to potential buyers that are renting, maybe they've rented forever, or maybe they just rented the last few years. This is something you can tell them. Hey, rent just in December alone, rents on average went up 0.5%. Rents are always going to keep going up, right? What's the likelihood they're going to go down? Not really much at all. So keep that in mind when you're talking to people to help them understand about buying now versus waiting. Rents are on the rise, and they're going to continue to rise. I've got it down in the presentation graph that'll help you with that. Inventory down 13%. Again, not a big shock, but we are in the slower season. The holidays, usually everybody just kind of checks out and they really just want to relax and chill from the whole year that they've had. So that's not a huge surprise. Obviously, I think we all know early spring, summer, and early fall, that's really when we're super, super busy. But that's fine, because you know what that does is that gives us January, February to plan, to be busy, right? To get all of our marketing in order, to get all of our plans in order, and get stuff scheduled, presentations, listing presentations, make sure you've got all that, solid. Don't wait until someone calls you to list or to buy to get everything prepared. So you've got some downtime right now. This is the time to use for that. Interest rates are higher by about 64 basis points, meaning about 5/8 in interest rate difference between now and the same time last year. And I will tell you this, that they are not going to go down. Now, they go down a little bit one day and up a little bit one day, but it's kind of like this, right? It's on the way up. We're probably going to be between 3.5% and 4% by the end of this year. I've got a graph about that later. I think Mike mentioned that on his call yesterday. So this is true. This is happening, and there's nothing that is really going to change that unless, say, another variant comes out that's worse than Omicron, or something happens, with the pandemic that takes us back a lot of steps, and maybe we might rise, but just on a slower speed. But I think it's just going to keep going up. Zillow and Pulsenomics. This is a survey of about a little over 100 of the top economists in the entire country, that they're estimating, and also you're going to get the slideshow, but write this down too to try to commit it to memory. They're estimating that appreciation is going to rise between 8.5% and 15% this year. So that's great, right? That's wonderful for a seller that can sell high now and still buy another home. Interest rates are lower, so they can buy more home and still get a really nice return just in a year. So that's another talking point that you can use when you're in front of people. CoreLogic's home price index for November. It's always a little bit behind because I have to compile all the data across the country and stuff. So it's usually a month or so behind what we're in. Home prices rose about 1.3% from October. Now, in the Bay Area where we are, we know that's going to be a little bit higher. And again, this is across the whole country. But it's still good anytime it goes up. So home prices rose about 1.3%, 18.1% year over year. Single family homes rose 19.4%. So, if you've been in this more than a little bit, then, single family homes are always worth more than townhouse, condo, duplex, triplex, quad. Why? Because they're the most unique you can get, right? A condo might be on 417 and you've got 200 units just like yours. So that's the reason that typically detached homes, single family homes, really no restrictions except for city and county ordinances, but no, HOA to deal with, no restrictions, so a lot more freedom. So that's why detached is usually always goes up a little bit more in value. There's a strong demand still. I've got, if I look at my board, I think I've got about 35 borrowers that I have pre-approved in the last 60 days. And not one of them this year so far has been able to get a contract. Okay, so strong demand. So that means that tight inventory is going to still be supportive of home values going up. Just like Mike mentioned on the call yesterday about the bubble, that's really not something that in the industry we think is going to happen. The reason of the crash back in 2010, that all happened because it was really bad loans that were given out before that, put people in really bad financial situations, adjustable rate mortgages that went from 5% to 18%, just crazy stuff because there was no regulation, no protection for home buyers. That's not in existence anymore, and it hasn't been. So typically, we're not going to see a bunch of foreclosures hit the market. Part of Mike's presentation yesterday, he touched on the percentage of people who were on a forbearance with their mortgage during the first and a half part of COVID, and what was the result of that now that those forbearances have been lifted, unless you've applied and you maybe continue on. But for the most part, people are either paying the balance in full or they're setting up a payment plan to catch up over the next year or two to go back and repay what they didn't. And some lenders are also allowing you to tack on a mortgage. It's not really a mortgage, but you tack on a separate balance at the end of your loan that has to be paid. No interest is to accrue from that extra balance. So if it's $20,000 and you've got it, the Bank of America says we'll put it on the back end. That just means when you sell or refinance, that has to be paid. Okay. So there's a lot of really, really great options out there for people who maybe still are struggling for their mortgage payments or to make them and to even catch up. Not very likely that anything's going to happen that people are just going to have to walk away from their homes. I think it was under 2%, if I'm correct, Mike, that you mentioned yesterday. And It's under 2% of people that actually did a deed in lieu or foreclosed or short sold. So you hear people talk about home or a housing bubble, just kind of don't worry about it because it's not very likely. Okay, interest rates are on the rise. We know that. I've been trying to set expectations with my borrowers to let them know, hey, this is where we are right now, but it's going to just keep going up. Why is it going up? I really simplified this, right? We don't have time, nor do we really want to deep dive into the whole economics behind it. So the talking high points, I've got 3 pretty easy to remember. Consumer sentiment is still very strong despite some minor economic slowdowns from the Omicron variant, but consumer sentiment is still very strong. Inflation is climbing at a record rate over the last few months. That is going to translate into interest rates going up. The Fed is planning to wind down mortgage stimulus and raise rates sooner than initially expected. Now, that has to do with the Fed buying bonds. Bonds are safe. So when bond prices are high, meaning there's a lot of people putting their money in there, Fed's buying a bunch of bonds. It's safer during this whole uncertainty of COVID. It was safe, but now people are starting to realize, hey, things are kind of getting better. We're not where we need to be all the way yet, but we're on the way a lot sooner than we probably thought. We're on the way. So now they're selling off bonds. Now they're going to take their money and invest it in more risky investments. Okay, so that's has a direct effect on mortgage interest rates. Buying time is now, guys, right? We know that. We want that 1% rise in the interest rate. So from 2.75 to 3.75, that's gonna lower the buying power about 10%. That's huge for us here because you're talking about 100,000, 150,000, 200,000, maybe a little bit more difference in sales price that someone qualifies for right now versus say July. Well, that could be the difference between buying a house and not buying a house in the Bay Area. So when you're talking with your borrowers, giving them information that sets you apart from other agents, right? Giving them things of value, you've got to let them know this. And you can back this up with everything you see on the news, CNN, CNBC, it's all out there. This is no surprise. The talk has been around for a long time about rates coming up, and now it's happening. We can physically see it in the market changes. So keep this as a big talking point whenever you're in front of new clients. Here's the 90-day rate forecast. Now this is going to be from, let me see, I can move this over here. We've got Fannie Mae, the National Association of Home Builders, National Association of Realtors, which you guys are most likely a part of, the Mortgage Banker Association, Wells Fargo, Freddie Mac. The chart here to the left, I started it from April 20th. Actually, that was supposed to be scooted over to March in 2020. Sorry about that, but you can see the spike there. That's when lockdown began, right? March 2020 is when everything shut down. And as you can see, slowly, well, not really slowly, right? Less than a year, we're at the lowest of the low down here, all-time low, 2.625. So that's all COVID. That's all COVID, lockdown, everybody's panicking. Investors are putting money in the bond market. Then you see in about April of 2021, if you guys remember when there was just a little bit of time where we're thinking we're about there, right? We're going to really do well. Now, I know Omicron didn't really hit hard till September, but we did have some time there where I think we actually didn't have to wear a mask maybe for a little bit of time. So things started to look a little bit better, but then we realized real quick, we're not there yet. So you can see the rates starting going back down. August 2021 dipped down a little bit, but not as low as they were January of 2021. This time last year, they're not that low. Sorry about that. I have my assistant here who doesn't like the UPS guy, the FedEx guy, or the post office delivery. So anyway, so you can see there, August 2021 it dipped down, and then now we're just back up, and we're going to be going back up, right? The 30-year mortgage rate forecast for first quarter of 2022 is anywhere between 3.10% from Fannie Mae's projection to 3.4% Freddie Mac's prediction. So keep this chart, add this chart to your presentation. If you do a presentation with buyers or sellers, add this chart in there. They can even go online and find this. This is not, I mean, I didn't do all the math to create this. Hey, this will help them understand, oh, okay, so you're not just saying interest rates are going up and I'm not just hearing it on the news. This is really, you know, these housing authorities here, these are solid, you know, we have to believe what they're putting out here because it's real stuff. Oh, maybe I need to click on this. Okay, let me make sure. Yep. Okay, so for example, loan cost, let's just say it's a $1 million loan, okay? The difference between 2.75 and 3.75, you look down at the chart here, this is going to be for the first 7 years. All right, let's just say principal at 2.75, $165,668. Go all the way to 3.75, $144,620. Okay, you can see this chart is just going like this, right? It's going up for each quarter. I put what the difference is between interest and principal. Just if you zoom out and you look at, don't even look at the number, but just look at the rectangles there, the purple, those are very close together. The orange, it's not quite half, but it's a huge difference there. So this might be something that you could show your clients that help them understand, okay, this is what the math looks like with rising interest rates. In addition to payment, I believe that's on the next screen here. Yep. The payment, look at this, 2.75 on $1 million loan. This is all 30-year fixed. Principal and interest, $4,082. Go all the way to 3.75, $4,631. That's a very significant amount, $549 more a month. That could be the difference between someone qualifying and not qualifying. So this is important as well to show to your clients so that they can see what the math looks like. You know, add another $500,000 to that loan cost, and then you're up, you know, almost $800 a month difference. So print this, keep it in your folder, your presentation, or you know, copy it into your own presentation if you like. But this is a really good way to compare differences in interest rates. It's just a little chart if you want like this as well. It's just a little bit more visual. Purple is the 2.75, orange is the 3.75. Okay, so now we've talked about the interest rate increases. What does it actually mean? Now you've got a visual of it. You can see the math, easier to understand, easier to explain to your clients. Now let's talk about loan limit increases. This happens every year. Fannie Mae goes back and reanalyzes the average sales price and income, all this kind of crazy stuff, and then they increase their loan limits. The loan limit for, basically, I'm going to go to, oh, maybe I missed it. It's in here. Hold on once. There we go. Here's Bay Area. The loan limit for all the counties that don't have a star is $978.01. So that means that at $970,801, that's a jumbo loan. Last year, it was $822,375. That's a $150,000 difference. That's crazy, but that's what it is. So we have to go based on those loan limits. Sonoma, Napa, Solano, they're kind of in a weird, kind of funky little place there. Sonoma, 764, 751. Napa, 897.01. Solano, 647,201. The Solano, the 647,201 is going to be the majority of what you see in California. I think there's like 35 counties. They're at 647,200 is the top end for a conforming loan amount. Basically, obviously, it's home prices, right? Average home prices. So let me go back to this. Okay. So you can see here, so you don't have to go on the website and try to figure it out yourself. I've just made it pretty simple. You've got, let's just say Alameda County, 1 unit, single family home or condo, townhouse, $970,800. Then when you start going up in units, duplex, triplex, quad, you do see that the loan limits do increase. So if you have a buyer who wants to buy a duplex, maybe they're going to live in one side, 1.243050 would be the maximum loan amount to stay conforming. Anything over that would be non-conforming, so on and so forth. So pick your counties that you're pretty used to staying in and working, and commit these loan amounts to memory, because you're going to need to know that when you're going to write a contract, things like that. Okay, this is Golden Ones, non-conforming, our jumbo and super jumbo matrix for the loan to values, FICO scores. 4 things to note out of this chart. You don't need to memorize this. You don't need to know this. That's for me to have committed to memory. But 4 things to note is that we can go up to a $3 million loan amount with a 700 FICO score. That's pretty awesome. Now, reserves, 12 months still, right? We are 12 months reserves now, pretty much across the board on all jumbo, super jumbo products. Under that, where it's Fannie Mae, conforming high balance, typically it's about 2 months, unless when I run automatic underwriting, it tells me no reserves are required, and that happens quite a bit. If credit scores, 740 or above, 720 or above, and ratios are not, stretched to the top end, typically I'm going to get something that says no reserves. But I think for the most part, people should definitely have a couple of months in reserves anyway, but we can get that out of 401ks if we need to. Okay, so 700 FICO up to 3 million, 20% down up to 3 million, just 20%. We do interest only up to 2 million on the loan amount. Our cash out is up to 2 million on the loan amount. The actual cash out is 500,000. Okay. These are all pretty aggressive guidelines, I think. I'm not really seeing much of this out there at all with other lenders. We have changed a little bit this year, updated some of our guidelines, and these are, in my opinion, I think they're very generous, and I think applying some of this to your own marketing material and knowing what you can go after. Let's say you're sitting with a buyer who wants to buy a $1.5 million home. They say, well, I only have 150,000 saved. That's only 10%. I can't do anything. I have to have 20%. I have to have $300,000. I'm not going to have that for another year. But you say, oh, actually, I have someone that can do a 10% down loan, up to 2 million. Okay. Now you'll see here it says 80/80, but if you go right under that, that first line to the purchase where it says 80/10/10, the maximum CLTV, combined loan to value. So the 80% is the first mortgage, up to 90% would be that 80/10. 80 plus 10 is 90. So we can do that. Now this says, the third line there, the max loan amount is 1.5, but that's not true anymore. We changed it to 2 million. They just didn't change it in the chart, and I did not want to go edit anything that they had done. So I'll talk about that in a minute, the increase in the 80/10/10 offering, but it's 10% down. When you go over 2 million, it's going to be 20% down. However, we do have the ability to ask for exceptions on credit score, loan to value, and sometimes reserves. Okay. I am not permitted to tell you what the maximum exceptions those can be, but I can tell you that if it's over 50% debt to income ratio, we should still look at it. Okay. Now, with that said, Golden One is not trying to lend unresponsibly. We're not going to put someone into financial hardship. We typically tend to, if we're going to entertain an exception like that, we need to make sure that the borrowers have plenty of reserves, they've got good credit, I was about to say low debt to income ratio, but that's the opposite. Reserves, good credit, maybe they've got, bonus coming, things like that. We want to make sure that we're not involved at all in anything that would look or resemble predatory lending, because that's not what we're about at all. But we are about common sense underwriting, and we are about serving the community needs. And as I've said 100 times on these calls, the Bay Area especially is different than the rest of the state and most of the country, even with the home prices being what they are, we as the lender need to be a little bit more understanding of people's financial situations and still be able to offer products that help them build wealth by home ownership. And this is how we do it. Okay, so you guys can read through that however you want. We do also jumbo investment property purchase up to $1 million right now. We have asked for that to go up to $1.5 million. They haven't made a decision yet. I don't see a lot of investment property jumbo, but if that's something that you want to get into and you've got a buyer that's got, you know, significant assets and they want to start buying some real estate, then we offer that. These are the conforming loan to value guidelines. Now this is directly from Fannie Mae's website. So again, feel free to go on their website and dig through and pull out what you like. I just like to pull out what is simple and easy. Keep things as easy that you commit to memory so that when you're presenting to your clients, you know exactly kind of where we're at. Things to keep in mind is don't shy away from 2 or more unit properties. Last year I did a few duplex purchases where the buyer was moving into 1 unit, and for Fannie Mae that's only 15% down. Same for FHA, only 15% down for a duplex. If you go into a conforming loan, non-conforming loan, if you're in the jumbo category, then you're going to be like 25, it could even be 30% if it's a quad or something like that. But this is also a great way to build wealth, especially first-time home buyers. If they have the appetite to be half landlord, then, you know, a duplex is a good place to put them. I've got some friends up in Oakland that bought a duplex, and I think they bought it, I want to say around $850 or something, and that thing's already worth, you know, $1.5 million, and that was a year ago, December. So, you know, it's still a great investment. Loan increase from 2 to 4 unit properties. I went through that for the jumbo on the other screen or slide. For Fannie Mae, we can dig through the website and get all of that out. If you have that situation, maybe out in a different area outside of the Bay Area, someone wants to buy a duplex and it's not jumbo, it's going to be Fannie Mae or conforming high balance, give me a call. We'll dig through, see what it is, okay? There's less down payment required for conforming loans, anywhere from 3% to 5% minimum, all the way to down cash out refinance investment property, 70% for 2 to 4 units. So that's actually still pretty generous. But you can see on the right side there the maximum loan to value. It says, for example, 90%, that means it's going to be 10% down. If it says 75%, that means it's going to be 25% down. Investment on conforming high balance, you'll see is only 15% down. For jumbo, it's 20. Okay, we talked about that one. Okay, so now we've talked about interest rates rising. We've talked about the loan limit increases for 2022. Let's talk about Golden One, what makes us different. The biggest thing, and I talk about this every time, is the 80-10-10 loan product that we have. Now, last year it was 1.5 million combined loan amount is where we were. Now we've raised it to 2 million. So, and I've got an example of what that means mathematically on the next screen, but I'll talk about that one next. That's pretty awesome. I really do not know another lender out there that's 2 million loan amount at 90% loan to value. If someone doesn't want the second mortgage, we can always just do a 90% first mortgage. They'll have mortgage insurance, which we don't like. So that's why we offer another reason we offer the second mortgage. 12 months reserves required on jumbo loans. The reserves can come from retirement accounts. That part, the reserves coming from retirement accounts, that's pretty standard across the industry. The 12 months reserves is what's not. A lot of lenders start at 12 and go up to 18, sometimes 24 months. But we're 12 on jumbo loans across the board. It doesn't matter if your credit score is 700, doesn't matter if it's 800, it's still 12 months reserves. Coming from retirement accounts, what we do, and if you keep this in the back of your mind, fine, but you don't have to, it's part of what I do, is 70% of what's in their retirement accounts is what we can use for reserves. They've got $100,000 sitting in a 401k, I can use 70,000 of that for reserves. Tax returns are not required unless you're self-employed or you own rental properties. Most other lenders are going to want tax returns if you have 25% or more of your income comes from bonus, overtime, or commission, or you're 25% or more owner in a corporation, that would make you self-employed. Then we would have to have tax returns. I don't see that a ton, but I get them every now and then. But for the most part, tax returns are not required. I still have people upload them, don't need them. Definitely never need state returns, and just kind of on a side note there. So tax returns aren't required. RSU income, restricted stock units, that is what a lot of people in tech, how they get bonused, and sometimes a lot of their salary can come from RSU income. And basically what happens is, let's just say you start at Google and you've got a 5-year plan, 5-year contract or so, and the first year they award you 1,000 shares of Google that will vest in 2027. Then the next year they award you another 1,000, and the next year another 1,000. And then, so what that means is then 2027 you start vesting in your stock at the stock price then. So it's pretty awesome. To be able to use that as income, the way we look at it, which is a little bit more generous than the standard out there, is we use the lesser of either the 2-year average or the 36-month vesting at the 52-week low stock price. Don't remember that. You don't need to. You just need to know that that's very generous. On one of my calls last year, I talked about a borrower who I had about $17,000 in income for him. Our guideline updated last year pretty late, and I was able to, in the middle of his transaction, recalculate his income based on these new guidelines. And I was able to go from $17,000 to $29,000 for his income. That was a difference between him not buying the house and buying the house. Okay, so keep that in the back of your head when you've got a client that says they have RSU income. That's what it is. Waiving escrow is at 10% down. So we don't require you to escrow, or your borrower to, or your buyer to escrow with just 10% down. Most lenders require it unless you put down 20%, and then you don't have to. We don't require it. It really does help a lot when you've got a client who's, they're really short on their cash. They're putting 10% down, so maybe they're short on cash. Maybe they've got just enough reserves that we need. But adding an escrow account could result in them bringing, several $1,000s more to closing, depending on what time of year you close. I mean, you could be bringing $10,000 more to closing just to set up the escrow account. We don't require that, so that stays with the client. Or, I mean, that could be something that would even decline the loan, right? If they don't have enough money, if they're not putting 20% down, and the lender requires an escrow account, and you say, well, you've got your closing costs, you've got your down payment, and now I need another $8,000 to set up your property tax bill and home insurance account so we can pay it. Do you have that? No, I don't have that. What can you do? You borrow from your 401k, maybe, sure. But then you're paying interest on taxes and home insurance. Is terrible, terrible idea. So we don't require that. Okay, it really does help a lot. I think I mentioned this a minute ago. 700 is the minimum FICO score for jumbo loans. Our debt to income ratio is 45%, but we can actually go up to a 50 with some compensating factors. Again, maybe they've got more reserves than 12 months, or really high credit score. Different type of income situation where we see they're going to be bonus maybe down the road or something like that, or get a big chunk of change and stuff like that. So we can anticipate that it's not going to be long-term like that. Maybe it's something we could do. I've had quite a bit of success doing going over 45% with jumbo. Even on the 80-10-10 loan program, we can still look at that going up to 50%. Most lenders on jumbo are going to start around 720 for the FICO for that. Asset depletion. So this is going to be for people that have quite a bit of assets. Maybe they don't get a lot of monthly income or something, or maybe even they're retired. They get a little bit of Social Security or maybe a little bit of dividend or something like that. But they've got a lot of cash in the bank or assets, stocks, all that stuff. We can basically take the assets, use about 70% of the assets to divide by 360 days. 360. oh, I'm sorry, that's 30 years, 360 months, and do a little bit more math, and then we can use that as income. It's not super common. I've run across it, I'd say maybe 3 times last year, and we ended up not even needing to do that. So, but if you've got somebody that says, you know, I got X amount of money in the bank, but I don't have high monthly income, that's a good phone call to me. So I can do the analyzation for you. Our professional program we have for people in large medical groups like Kaiser, we do allow, and I have seen this where even this last one was Kaiser, where Kaiser gave the physician $50,000 in a third mortgage, which is weird, right? $50,000 in a third mortgage that Kaiser backed, and the physician, after they were there a certain amount of time, then Kaiser, it became forgivable, so the physician didn't have to pay it back. But we're one of the very few lenders that will allow 3 liens. So we will have a first mortgage, or it could be a second lien if they put down 20%, but typically they're not going to need that if they're putting down 20%. So we'll allow for a third lien if it's needed. Departing residents, I'll talk about that here in a second. I've mentioned it before, just wanted to keep it in your guys' mind, top of mind. We can still go up to a 55% debt to income ratio. In the next slide here, next second, I'll tell you what the specs are on that. Non-permanent resident loans, fine. Lenient on most visa statuses, fine. I haven't run across a funky visa status yet that I wasn't able to do. So if you've got someone who's been here a little while and they're working, but their visa is kind of funky and they're not getting what most lenders need out there, give me a call and I'll run it through and see if we can do it. Most likely it would be a yes. Verification of rent, we typically, you know, honestly, I don't think I've even done or seen us do a verification of rent for any loans I've closed since I've been here. March will be 2 years. So we typically don't really need the verification of rent. Legal marriage settlement agreement is not required. Most lenders are going to require all of the documents. We just need a notarized letter and only 6 months receipt of alimony to be able to use that as income. Most lenders are around 12 months. Like I mentioned a second ago, make sense loans. Those are going to be the one-offs that are kind of funky, weird. Maybe the debt to income ratio is over 50, but we've got some strong compensating factors. It's not something we're going to say no to, but it is something we will look at and see if it's something we can work out. So call me if you have anything that's kind of, you know, you think there's no hope. I want to be your the last person you try. Or actually, I want to be the first person you try. But if everyone else has been turned them down, give me a call and let's see what we can do. Let's see. One moment here. Excuse me. Okay, so let's chat real quick about the 80-10-10. It's okay. The 80-10-10, going up to $2 million on the loan amount. Here's some examples here. Well, first of all, the 80%, we always do an 80% first mortgage. That's how we avoid mortgage insurance. We'll give them a second mortgage at 10%, and then they'll put down 10%. So that's how we have, how we can get up to the 100% is 80, 10%, 10%. Okay. On this, FICO up to $1,700,000, up to $2,720,000. The second mortgage is an interest-only payment, which is pretty awesome. On $1 million loan, it's like $430 or something like that. $100,000 HELOC. So that's the cash flow wise, it's pretty awesome. People can definitely pay more if they want. I put if the borrower's got 20%, they can still do an 80-10-10 and then just pay off that other 10% after closing, and then they've got a line of credit for $100,000 to it, whatever it ends up being, that they would never be able to access afterwards. You're going to be at a 90% loan to value on this. If you close and then you're sitting at 80%, you put 20% down, and then you call me after closing, or you call any lender out there, and you want that 10% equity line of credit, you're not going to get it. Nobody does a home equity at 90%. It's always at 80. Maybe there's a one-off out there or something like that. I mean, you guys could tell me, but I have not ever seen one that goes over that. So a lot of times, I mean, I'll even suggest open the HELOC, keep it, pay it off. You've got a line of credit for 10 years. Use it if you want. Don't use it if you want. You've got kids going to college soon. Use it. If you can renovate your house, use it, whatever you want to do. So example number 1, purchase price $2 million. Remember, you've got a client who says, only have a couple $100,000. I don't have enough. Wait a minute. Yes, they do. Purchase price $2 million. I'm going to give them a $1.6 million first mortgage. They're going to put $200,000 down, and then I'm going to give them a $200,000 second mortgage. Now, that equals $1.8 million. So we're still way under what is allowed. Remember, we can go up to $2 million combined loan amount. So this, but I just gave you a purchase price just to kind of help you understand, even at a $2 million purchase price, 80-10-10 is still there for you. Example number 2, $2.125 million purchase price. I'm going to give them a $1.7 million first. I'm going to give them a $212,500 second. And they're going to put $212,500 down. Both of these, 12 months reserves still. Okay, so this is a huge, huge, huge part of our business. It's a big part of our business. I close a lot of these. One of my buddies here closed, I think, 30 of them last year, 30 of the 80-10-10s. It's not going away. We love it. It's a great program out there. When we look at these loans and how they've performed, they've been amazing. You know, we haven't had people be late. We haven't had people default. You know, things like that they've not happened. If they had happened, then we would be scaling back. But we're increasing the offering, which means that this is a very healthy loan out there for people. And we've got really great underwriting guidelines for it. So when you hear someone say, I don't have enough money, call me. Let's look at this, see what we can do. Now that the conforming loan limits have changed, here's what that looks like for your clients when you're out there looking at purchase price. And remember, these amounts are loan limits, not purchase price, but loan limits. Example, with 5% down. Purchase price $1,025,000. That's 5% down, believe it or not. This time last year it wouldn't be, but now it is. It's 5% down. $1,025,000 purchase price is $51,250 down payment. I'm going to give them a $973,750 loan. Oh no, that's not. Oh wait, no, that's right. I'm sorry. I have to stay under 9. No, that's wrong. Geez, I'm sorry. I don't know what I was thinking when I made that one. Forgive me, please. That's loan amount's $973,750. So here's what we would do. At $1,025,000, they would just put down, say, $55,000. So it's still not huge. But we just have to keep that loan amount at $970,800. I'm going to go back. It's probably her. I think she's the one that did the math on that. Harlow. Go back and check that calculator. All right. 37 counties in California with loan limits at $647,200. That's a lot less, right? But typically in those areas, that's still going to serve the community pretty well. Loan limit for that, typically you're going to be around $675,000, $680,000 purchase price, down payment 5%. For this one, $675,000 purchase price, $33,750 down. I mean, with the way 401ks have increased here in the last couple of years, I think I read on CNBC it was around 24% on average increase in value. That's phenomenal. I mean, I'm happy if I'm 6 or 7 or 8% return on my 401k, but it's just skyrocketed. So now's a really good time to reach out to people that maybe in 2019 or whenever they didn't buy anything because they didn't have money. Give them a call. So what? It's been a couple of years. Who cares? I had a guy call me last night. I haven't talked to him since 2020, March of 2020. And here he is with a contract. So give them a call. These people are still out there probably not thinking they can do anything. But now you're going to be the one to bring them some hope, right? So this one, down payment $33,750. We've got a loan amount of $641,250. Now, I bet you're asking in your head, is there mortgage insurance on these loans? Yes, there's always going to be. These are Fannie Mae, Freddie Mac loans, FHA, VA. There's going to be the same loan limits. There's going to be mortgage insurance, definitely. But with conforming, the beauty of that mortgage insurance on conforming is it's not going to be paid forever, right? So there are ways that you can drop the mortgage insurance on conforming loans. With the forecasted appreciation coming up here between 5 and 18%, is that right? Yeah, 8 and 15%. Maybe someone pays mortgage insurance for a year or two, and then we can look at dropping it. the way to drop it is to call me. Hey, Jody, I think I've got equity now. They will pay for an appraisal, $500–600. We'll analyze it. If the equity's there, mortgage insurance is gone. Or if they never call, then it'll just eventually drop off following an amortization schedule, the original amortization schedule. That's going to be a while, right? We all know that. Like 10, 11, 12 years. So I really do emphasize to people that are in the conforming high balance area, and they don't have quite enough to put 20% down, that's fine. Let's do it this way. And then give me a call in 6 months. Let's take a look at it. Let's do a quick little analysis online, see kind of where you're at. If you're close, makes sense to get an appraisal done, see if we can drop it. I already talked about this, but reserves, again, 12 months on jumbo loans. You'll see where it says other real estate owned, 2 months. Okay, that just means if you've got, you're buying a property, but you've got an investment property over here, then we need 12 months reserves on this and 2 months reserves on that. That's what that means, other real estate owned. Departing residents, and typically, well, you know what, I'll hold off on that because that's a different slide. Anyway, you can see there that we don't go over 12 months, no matter credit score, no matter what. Departing residents, excuse me. Departing residents. So we have had this guideline out last year, but I think it's important to talk again about it. So let's say you've got a client who, you know, their house is in contract, they're selling it, they're in contract, but maybe that buyer is not going to be able to close in time for their new purchase to close. What do you do? Their equity's tied up. Their ratios might be a little bit high because you got to count both payments, right? Because what if that contract falls through, they never sell it, or they don't sell it for 2 or 3 years? Lender still needs to make sure that they're not putting these new buyers in a position to be in trouble financially. So here's how we look at this, and what we decided is a make sense loan for those people in that situation. If they're purchasing another house, got a contract, they have a contract on their current home, here's what we'll do. We'll not require that the current principal residence, what they're selling, principal, interest, tax, insurance, association dues, that's what that A means, but it doesn't always apply. PITIA. We don't require for that to be in the qualifying ratios, provided that 4 things. We have an executed contract sale, or an executed sales contract for the house they're departing. There's no finance contingency still in place in that contract. The debt to income can go up to 55% as long as there's a 720 FICO. And the new property, they're putting 20% down. I'll tell you how to, if you're like, well, maybe they don't have that. You just said equity's tied up in it. I'll tell you how we can help them with that part. The departing residents should be listed, of course. Obviously, it should be listed if you've already got a sales contract, but maybe it's an off-market sale or something like that. I could probably get around not having to have that part if it's an off-market sale. That's really not super common, but that might be a one-off that I can get addressed. All right, and then we document additional 6 months in reserves for the departing residents. That's what helps us be able to go to the 55 and still feel like we're not putting them in jeopardy financially. The CLTV, the combined loan to value on the departing residents, is basically a desktop appraisal. It's something we do automatically, blah, blah, blah. They don't have to, we're not gonna have them pay for an appraisal. There's no appraiser gonna go out there and take a look at it, none of that stuff. It's just gonna be a quick desktop, and typically they always come in pretty, pretty close to market value, if not a little bit higher. So this is really great. So you've got a seller that, got their contract, have another contract to buy a new house, got some issues with the closing on the first one. Here's how we can work that out. Now, remember, I just said that their equity is tied up, most likely, maybe not, but for the most part, people's equity is tied up in the home they're leaving. Here's how we can help them with that. To get to that 20% down so that we can go up a little bit over 50%. Ooh, there it is. is a home equity line of credit. You've been on my calls before, I've talked about this, but it's worth repeating. We can offer up to $500,000 line of credit. Now, that's what, a little over $2 million purchase price that they can basically borrow the entire down payment. So they're not having to pull money out of their stock market. We don't want to create a taxable event if we don't have to, right? Let's use the equity in the house to take care of that down payment. Plus, it's going to sell soon, right? So that's going to be paid off. It's going to be very short term. Up to $500,000. Only need a 640 FICO for that. Now, on the other side, right? We need the for jumbo, we need 700. But we can even do this on conforming loans, right? Under the $600,000, that minimum credit score is 620. So that's pretty awesome. This is not just for jumbo. It's an interest-only payment for 10 years. Feel free to pay it off if you want. Keep it open for 10 years. There's no balance. There's no payment. Pay it down when you get a bonus or when your RSUs vest, something like that. Or this is pending that your house didn't sell or their house didn't sell and they weren't able to pay it completely off. We could always look at refinancing that. Draw period's 10 years. 30 days seasoning on title. That just means that the house they're departing, they need to have at least owned it for 30 days. I mean, come on, we all know that. I don't even know why we even put that on there, right? Because it's people are going to definitely be in their house more than 30 days to even get to a new contract and all that stuff. So this is for primary residence, second home, investment property. When someone's departing their current home to buy a new home, that HELOC, that bridge HELOC, what we're talking about, is going to be priced at investment property because they're leaving. This is their new owner-occupied home. You can only have one owner-occupied home, only one. I've had people argue with me about that. I didn't write the guidelines. Those are the guidelines, and those are not going to change ever. And that's true for every lender in the entire country. Only one primary residence, okay? So we will have to price that particular home equity as investment, a couple points higher, but again, it's a bridge HELOC, short term, most likely going to get paid off very soon. If it's a second home, say maybe they got a place in Tahoe they're selling, it might be a little bit less on the interest rate, but again, it's so short term that it's not really much to even worry about. Here's an example. Let's say purchases 1.25. They want to put 20% down. They've got enough equity in their departing residence. They don't want to do 80-10-10, then we're going to take out $500,000. If they want to just do 10%, the 80-10-10, to literally borrow everything, we can actually do that. They're going to put down 250. I'm sorry, they're going to put down 125,000, put down 250,000 on this is 20%, but we could still do 80-10-10 with that as long as they qualify. We got a lot of fun stuff. This should help you guys be able to close more deals and help you guys be able to have something to offer your clients that, you know, somebody at the big banks can't offer. Sorry, I was just at big bank for so long. All right, rental income. Not super common, but it's worth mentioning. Just to, again, keep in the back of your mind, you're out having conversations with people. Maybe you're around the water cooler at your real estate office and got somebody that's like, you know, this guy can't qualify. Here's how, if it's anything to do with rental income with less than a 2-year history, most lenders require 2 years filed tax returns to be able to use any rental income at all. We don't. If you've never owned rental property before and you're trying to use rental income from a subject property that you're buying, we can't use it. Sorry, excuse me 1 second. I just need to let her out because my nephew just got home and she's going to just start until she gets to go see him. So 1 moment. Okie doke. All right. Okay. All right. So if they've never owned rental property before, we can't use any rental income. We do still want to make sure they know how to manage it, manage rental properties, but they don't even have to have a year. Okay. They can have less than a year, which means no signed tax return, federal tax return on that. We're going to want the lease and copy of the security deposit, things like that. If they have less than a 1-year history of receiving income, or they've got some documented property management experience, then here's what we do. For the principal residence, rental income, basically just the entire housing payment per month, we can offset that, take it out of their ratios. Okay, that can be the difference between someone qualifying and not qualifying, especially around here. This can be $4,000 or $5,000 payment that we can take out. Okay, so keep that in the back of your head. If they currently own a primary residence, they've got 1 year plus rental income, then we actually can use the entire income, even if it's more than the actual payment on that property. I briefly mentioned residency and visa statuses. Here's a quick little chart. This is pulled here from Fannie Mae's website. You know, every lender pretty much underwrites Fannie Mae guidelines, and then you either have more strict, called overlays guidelines to those Fannie Mae guidelines, or you have more relaxed, like us. Okay, here's a few things just to kind of keep in the back of your mind. Permanent resident, green card, work visa, entry stamps, employment authorization document, I-551 stamps, all that kind of stuff. We can do a lot of things with residency statuses. So if you have anybody that's out there thinking they can't buy because of their visa status or their residency status, that's a phone call to me. I'll run it through and most likely give you the go ahead. All right, that was it. A lot of stuff, I know. You guys have a copy of this. Print it, edit it, do whatever you want. I don't care. It's PowerPoint. Put it in your presentation folder, read it at night, study it, memorize it. No, I'm kidding. Anyway, it's really good information. It makes me very excited about this coming year. I know that I've got some goals that I've set for myself, and we are at day 13 in the year, and so far I'm on track to meet some of those goals early on. So I'm excited. I'm here for you guys anytime you need, evenings, weekends. You've got my cell number. Call me, text me, email me, whatever you need. If it's 10 o'clock at night and you've got something urgent, give me a call. One thing I didn't put in here, but that I wanted to also let you know is I can close around 18 to 21 days, pending the appraisal comes in on time. We are still experiencing delays with appraisals. It's getting a little bit better, but it's still, you know, could take 2 weeks, and that's it's just annoying, but that's what it is, and it's like that everywhere. But if we can get that appraisal in quickly, then we can do an 18 to 21 day close. Again, make your people more look more attractive on their offers for a quick close, and no finance contingency. So, you know, I'll let you know, hey, this loan's solid, it's great. If it's something kind of funky and we need to run it through formal underwriting, I'll run it through formal underwriting. A lot of times I don't need to. It's W-2 income. They've got their assets, you know, pretty easy. Credit's fine, you know, nothing kind of crazy that would cause any issues. You don't really need the finance contingency there. Okay, well, I'm going to turn it back over to Mike. Mike, if you want to do set it up for Q&A, that's fine. Or if you want to add to anything I've said, you know, floor is yours.
I got nothing to add. Some of the Q&A, want me to read them to you?
Sure.
All right. What would the loan amount, I guess, I think you may have covered this, but the difference in the loan amounts, if it's an investor?
Difference in loan amount and investor, the occupancy doesn't matter. The loan amount is still going to be the loan amount. It's still going to fit those guidelines.
And there's been requests for the handout, which I pasted in. Let me see if I can get another copy of it. So does everybody have a copy of the handout? Let me I'm trying to do this while I'm reading. So I'm going to paste it in again.
Okay.
To everybody. You do VA loans?
We are getting it this year. We were supposed to have it in 2020, but COVID, it kind of stopped. But they're working on it, actively working on it for us to be able to have VA very soon, I hope.
All right. I've resent the link several times to the presentations. I pasted in your contact information, which I think at several. What are the limits in Orange County?
In Orange County, I believe Orange County is going to be 970, 800.
All right.
Yeah, because
my client has been in the forbearance program, can they still refinance?
So the way that lenders are looking at it for an actual refi is that the loan has to be current. Or they have to show that they've got the agreement in place that the money that's tacked on at the end has to be paid or can be paid at the refinance or purchase. But they just can't be still in forbearance and they can't be late on anything.
All right, out of forbearance and not late. Melody was asking about proof of fund. This was near the end of your presentation, so I assume that this was probably, well, you know. What would you show for proof of funds in this scenario, Melody asks? So are you showing, like, if you get the bridge?
Uh-huh.
I think that might be what she's referring to, because that's
Okay.
where proof of funds becomes interesting.
Yeah, it does become interesting because for us to close a home equity, it's about 2 to 3 weeks. It still can be done, during the transaction period, but I should know and you should know pretty much before contract that this person's going to need that HELOC. And then we need to get that going now, the application going now. There's no charges for us to even originate the HELOC. They can literally not even sign until they actually get a contract and ready to go. So it's something we can jump on ahead of time. If we're able to jump on it ahead of time and get that HELOC in and they can fund their account with it, then there's their proof of funds right there. I'm also happy, and I have done this before, to speak with a listing agent to let them know, of course, don't share very much in detail with the listing agent at all for buyers, but I do let them know that, hey, we allow this. It's going to keep them from possibly having a taxable event cashing in stock. So this is the way we're doing it, already underwritten, already approved, blah, blah, blah. Whatever conversation I need to have to help out with that, I will.
So in the bridge HELOC, is it possible that your pre-approval letter might mention that there's been a verification of assets sufficient to close?
So my approval letter does say that I verified assets, and in my mind, in my opinion, is if we're doing a bridge HELOC and they're approved for it, and it's it's good to go, then to me, in my mind, I verified. I'm not going to put that there's a bridge HELOC on an approval letter. If they're pulling all of their money from a HELOC, I'm not putting that on the approval letter. If they're doing 10% down and that's coming from a HELOC, like the 80-10-10, I'm still giving this letter at 20% because they are putting 20% down. Less is more, and now I'm not going to give them a letter at 20% down if we don't have an approved way of doing it already. Okay, I'm not going to guess and just assume. I'm going to make sure that we've got everything done, crossed our T's, dotted our I's, and as long as I know that money is there, or they can draw off of it, or they, we're doing the 80-10-10 and they're approved for it already, then I'm going to give them a letter at 20% down. If the buyer wants me to put that in the letter that they're getting that, then sure, fine, fine with me. I'm happy to do that. And that's pretty much the same with all of my counterparts here. The golden one, for the most part, that I know of. Are you still there? Oh, what happened? Oh my God. Did I get cut off? What happened? Oh, can you hear me? I can't hear you, Mike. I can't hear you. I can't hear. Are we saying bye? Okay.
Can you guys hear me now?
Oh, yes, I
All
can
right,
hear you.
I don't know why one of my mini microphones just checked out. All right, I'll have to keep that in mind. It was working just a few minutes ago, but that's the way life is. So what I was saying before technology interrupted me is that the residential purchase agreement that mentions proof of funds does not specify the form that needs to take. Now, there's a belief among some real estate agents that it's bank statements and nothing else. There's nothing that says that. And I've had clients who would not give bank statements as proof of funds. They gave it to the lender, but they wouldn't give it to the seller. And do you know why? And the reason is because it showed that they had more money in their account that they could have paid cash for the house. This, by the way, was a $4 million property. And the guys, I'm not showing people my bank statements. They have no right to see them, but they show them to the lender. So if you don't want to, you don't have to give bank statements. But if the lender is willing to say in their pre-approval letter that they have verified that there are assets sufficient to close, that should constitute proof of funds sufficient to satisfy the residential purchase requirement. Not everybody is willing to give up bank statements. I'm just saying, when you reach a certain level, they don't want you to know how much money they have, right? So that's not as unusual as you might think, that they won't give bank statements. And then they can call the loan agent up and say, have you verified that they've got the right assets? And she'll say, yes, I have. And then, hopefully you're good to go. It's Miller time.
Yeah, and I'm not allowed to provide anybody bank statements. I can't even send them back to the buyer. Okay, so pretty strict on that. So it's just not secure for me to email out someone's asset statement. So we just don't do it. So if you call me wanting verification of funds, I'm not going to be able to give it to you.
Right, but if it's in the pre-approval letter, that constitutes proof of funds.
Yeah, go.
Right?
Okay. Have
You
more
must
visibility.
feel really safe with all those aggressive guard dogs.
This one right here is lazy as they come. But yeah, okay, here we go. Here we go. Okay.
All right. So any other, we've got somebody likes your doggy. Yeah. I like is that a pink mohawk or a purple mohawk your dog has? That's
Yeah, she's always had it. Actually, it's easy for me to find her in the backyard.
I'll bet. All right. Any other questions you guys have, reach out to Jody. I'm glad everybody, we're glad you showed up. Be safe out there. Next week we'll be doing something entirely different. I'm not sure what it is, but it'll be wonderful. If you're interested in talking about getting started, many of you know that I'm with eXp Realty and I have a team that's actually doing fairly well. If you're interested, if you're not on it and you're interested in talking about that, reach out to me. I'd love to talk to you. Thanks, everybody. Stay safe out there. Have a great day.
Hear from you soon. Bye.
Bye.